Hi, I'm Hunter Hutt, Director of Business Development, and today I'm here with CEO and founding partner Andrew Torres. Today we're here to discuss the recent performance and opportunity set in our investment grade credit mandates. January was a difficult month for most assets, as both the TSX and the Canadian Bond Index finished in negative territory. Meanwhile, our funds posted their 10th straight month of positive performance while maintaining our customary low volatility. Andrew, do you mind highlighting the main contributors to performance throughout the month?
Yeah, thanks, Hunter. First and foremost, interest rate hedges. That played a big part as we saw higher rates and steeper yield curves in January. So the fact that most of our corporate bond portfolio was lower in price but tighter in spread, we were still able to extract value given how we're set up. Second is that our derivative overlays played a big part. So these are hedges in place to mitigate losses. They contributed positively in January. And lastly, it was just the bread and butter of actively trading the portfolio, rotating out of some of the trades that had performed mid-month, and then recycling that capital through kept us in good stead with a solid month.
And so, how are you setting up the portfolio going into Q1?
So we made a couple of small changes in January. We first of all, some of the curve flattening trades that we had put on in the fourth quarter. These were to take advantage of steep credit curves. We took profit on those trades in January. We moved that capital from the 30-year part of the curve back into the 5-year. That's worked well for us. And secondly, we rotated out of some of the more volatile sectors like energy and REITs. Again, those had performed well in December and January, and so we took profits and we moved that money into more defensive sectors like the banks.
Andrew, you and I often speak about this environment being a yellow brick road filled with potholes. How are you going to navigate this path?
Well, I think first of all, investors have to keep in mind that we are intended as the defensive part of their portfolio. We are seeing investors move capital out of equities, out of high yield, and into investment grade credit. And they're doing that just because of how high and how tight the valuations have become early in 2021. So investors should feel good about being in a portfolio like ours during uncertain times. Secondly, the fact that we actively trade. This is what we do. This is how we extract value. We play in new issues. We look at relative value. We're continually rotating the portfolio to try to extract value, and that's working well in a market which is not necessarily trending but moving around. And then lastly, these derivative overlays that we put in place are meant to be a defensive play, which will help to mitigate any losses if we were to go through a sustained period of credit spread widening.
If you have any questions, please feel free to reach out to a member of our team. Thank you and stay safe.